Hey everybody, it's Dr. Joe's in the house on this Wednesday evening. A couple of minutes late, but hope all is well. And got another good session lined up, understanding different types of real estate investments. And I thought I'd choose this topic because I get asked questions. Well, Dr. Joe, should I do short-term rentals? Should I do multifamily? Should I do commercial? Should I do residential, single family, and so forth? And I'm kind of I don't like tell people what to do. There are pros and cons with each investment vehicle and asset class. And there's never a perfect one. It just depends on your situation, your strategy. And so I thought I'd have a session today where I sort of highlight different types, and I'll go through some of the pros and cons of each. And then, and then I'll leave it up to you as to which one you want to choose. Me, I do single families, primarily, houses where I participate in the Section 8 program. A lot of my tenants, it works for me. I've made it work. And, but I'm not saying it just because it works for me, it works for you. There are other people out there who would, disagree intently or forcefully that, I should do commercial, I should do multifamily, I should do short-term rentals and so forth. And I can argue with them about, why I do what I do and why, I don't agree with them. But, at the end of the day, it really depends on you. So today I wanted to share the different types of investment strategies. And, hopefully it'll shed some light for you and help you decide as to which one makes the most sense for you. Okay, so again, the topic today is understanding different types of real estate investments. So I'm going to get going. But before I get to that, as usual, if you've got some questions, please put them in the chat box. I'll get to your questions in about 20, 25 minutes or so. Anything to do with real estate investing, any problems, challenges you're facing, any issues that you feel like you can leverage my 30 plus years experience, please put it in the chat box and I'll get to you very shortly. As always, you can always book a one-on-one where we can do a deep dive into your situation, any challenges, any problems that you're facing, a lot deeper than what we can do during today's, live stream. So you can book a one-on-one. Just get to my website, www.joeasimo.com, www.joeasimo.com. I had a great session today, where we're talking about, I do a deep dive. This investor who purchased the property in the Washington, D.C. area. And one of my take on some of the things that she should be doing in preparation for implementing her house hacking strategy. So we had a good session today, Miss Fields. Enjoyed the discussion, and it was good. She enjoyed it. She thought it was extremely helpful. Same thing for you. There's no point making mistakes. Leverage on my experiences, and hopefully you can get to where you need to go to a lot faster. So with that said and done, let's get down to business, understanding different types of real estate investments. So I suppose the question is, are you investing with strategy or just hoping the numbers work out? Many new, intermediate, even seasoned investors struggle because they chasing deals before they truly understand what kind of investment really fits their goals, what works for them. So without clarity, my experience is that a lot of investors just waste time, lose money, and become overwhelmed by management demands, or even underwhelmed by the results. What they were sold is not what they experienced. The reality is that the difference between frustration and freedom, financial freedom, that is, anyway, often lies in choosing the right investment type. So today in this live stream, we're going to explore the good, the bad, the ugly of different types of residential investment strategies, backed by some of my experiences, lessons learned from myself, plus also other people. And so whether you're building from scratch or scaling up, my goal is that today's live stream will help you avoid common pitfalls and move forward with clarity and hopefully confidence. Okay, so I'm going to break into 7 parts today. I normally do 6, but I thought I'd do an extra one, 7. I'm going to talk about single families. I'm going to talk about what else? I'm going to talk about single families, short-term rentals, multifamily, turnkey properties. I'm going to talk about house hacking. I'm also going to talk about real estate syndications, and also going to talk about REITs, R-E-I-T, real estate investment trust. So I'm going to cover a lot of different things today. 7. It's going to be information packed as usual. So let's get down to number 1, which is single family rentals, which is a bulk that most people do when they first start off. And that's where I've decided to focus my efforts on. And single family rentals. So the question then becomes, can one door really change your financial future? Can buying individual doors or individual properties can really get you to financial freedom? Well, my response to that is yes, but let's just go on. So single family rentals, or SFRs, single family rentals, SFR, are really the biggest entry point for most investors, and for a good reason. They're relatively easy to finance. You can get conventional financing through FHA, commercial, residential. There's lots of different ways you can finance single family properties, and they're simple to manage, or at least simpler if you get the right tenant, that is, anyway. And they really appeal to a larger pool of people. So most people want single family houses, and so there's a lot more people to choose from. But while they offer stability and predictability, they also come with limitations, especially in terms of scale. Investors who have succeeded with single family rentals often start small, learn the ropes, and expand intentionally. Okay, so they start small, figure out what's going on, what works, what doesn't work in their area, and then they expand intentionally. So successful single family rental investors emphasize the importance of buying in the right neighborhoods. Okay, right neighborhood, location, keeping rehab costs under control, and building relationships with quality tenants. Quality tenants are the key to your sanity in the in this environment. And if you get the wrong tenant, you're gonna have a hard time. So one investor shared how $15,000 rehab in a working class neighborhood can yield in 10 years of uninterrupted cash flow. You can have tenants that stay 5, 10, 15, 20 years. My longest tenant is 28 years. But if you do have a turnover, it can be very expensive. You can have several months of lost income, which, if you're not careful, can wipe out your cash flow for several years. So it really, if you're going to go into single family residentials, the key is going to be making sure you get the right tenants. And quality tenants are attracted to quality properties in quality areas and renting from quality landlords. So they're all connected together. And so you do need to understand how to screen, how to select, and how to manage tenant relationships if you're going to be focused in a single family rental asset class. So the setbacks obviously can be frustrating. Vacancies can be very expensive. Hidden maintenance issues, things go wrong. And the difficulty of generating significant income with just 1 or 2 properties. You can't, you're getting $300, $400, $500 cash flow. It's just not enough from one property to quit your job and pretend that everything's okay, because it's hard. So it's difficult unless you scale. It's hard to achieve financial independence with just 1 or 2 properties. However, with the right systems and the right mindset, single families rentals remain, in my opinion, a strong foundational tool for building long-term wealth. Additionally, single family rentals are often easier to exit if you want to get out, if you want to sell it. There's a lot more people that want to buy single families than there are commercial buildings or apartment buildings and so forth. So it's easier typically to sell those things if you have to. And the liquidity factor makes them an ideal stepping stone for those who plan to sell and reinvest their proceeds into larger deals. So that's single family rentals. And some of the action items that you may want to consider if you're going to focus on this is create a checklist for tenant screening. I can never underestimate the importance of tenant screening to reduce vacancy risk. Set aside 3 months reserves per property for unexpected, situations, repairs, and things like that. And if you're going to focus on that one, you may want to connect with other landlords in your market to trade insights and also contacts and systems as well. Okay, so that's number one, single family rentals. Number two, we're going to go to our multifamily properties. Okay, so we're moving away from the single family and now transition to the multifamily. So the question is, are more doors always better? I know a lot of people talk about doors. I don't particularly talk about doors because I don't see my tenants as doors. I see them as customers, not doors. But anyway, a lot of people, investors, they talk about doors. So the question is, are more doors always better? Is it better to have lots and lots of properties, lots and lots of doors? That's the premise behind multifamily. So multifamily properties, typically, these are duplexes, triplexes, 4-unit buildings, or small apartment buildings, where you offer, the appeal is scale. You now have more units, more doors, and therefore you can scale faster than single families. So with multiple units under one roof, investors benefit from shared maintenance costs. You only got one roof to deal with. Many times you got one set of systems to deal with, and so forth. And so you have a bit more reliable, resilient income stream from multifamily. But the increased complexity requires better systems and management discipline. So if you're going to go to multifamily area, you really need to have your act together. You need to have systems for collecting rent, systems for maintenance, systems for handling, for screening difficult tenants. You got to have systems in place. Otherwise, you have all these people in one place, and it could be a nightmare. And so on. So you got to have some management systems in place as well. So one investor shared with me how buying a 4-unit building helped them offset their mortgage while essentially living in 1-unit house hacking. So they lived in the unit free, and they were able to rent the other units, and essentially they're able to save money and then go out and buy more properties. So they used the house hacking strategy where they bought a property, lived in one, rented the other units out, cut down their housing cost to almost zero, and therefore they're able to save money to buy house number 2, and so forth and so on. So another noted, the stress of navigating city code violations in older buildings. Many times there are inspections, there are permits, there are licenses that you're going to require for renting properties. And if you have a multifamily, you've got other issues you're going to have to deal with as well. So as I said, you've got several people living in one unit or one building, and all it takes is one bad apple, and they can drive out the good ones. So screening becomes very important. Managing tenant relationships is very, very important. And also managing tenant dynamics becomes very, very important in multifamily if you want to scale this. So those who've thrived in this space focus on learning landlord-tenant laws, know the laws in your area, hiring the right property manager if you don't want to do it yourself, and ensuring that they have the reliable cash flow models in place. You got to have cash flows and money set aside for incidentals or if unexpected things occur. So when managed well, though, multifamily investing can be a powerful vehicle for early financial independence. Let me turn my mobile phone off. That way you don't get disturbed by these little, there it is, off. Okay. So multi-investment, they also open the doors to creative financing strategies such as FHA multifamily loans is possible. Seller financing becomes quite common, or joint ventures with partners becomes quite common in multifamily arena. So these tools, when used wisely, I emphasize use wisely, can significantly reduce your upfront capital and how much money you're going to need to do the deal. And therefore, you can increase your leverage. But be careful. Leverage is a double-edged sword. It can help you, catapult you to, building a large portfolio. But if something goes wrong, it can crush you very, very quickly. So in terms of action items on multifamily, analyze the cash flow potentials of 2 to 4 unit buildings in your area. Study local zoning and building codes before purchase. and also create a system for resolving tenant issues quickly and fairly. So that's number two, sorry. Now we get to number 3, short-term rentals. This was a big one a few years back. Everybody got into it. Even I got into it. But it didn't work out for me. I exited that line of business. It was just too much trouble, too much work, and a lot more uncertainty because competition increased, and the room rates I was getting, it just wasn't worth it. So I just reverted back to what I always do, which is long-term rentals. So short-term rentals, STRs. It's a real good classy. When I talk about short-term rental, I'm talking about things like your Airbnbs, the VRBOs, and furnished finders and things like that. So can nightly rates really beat monthly cash flow? Can the allure of higher cash flow with short-term rentals, does it really pan out when compared to long-term rentals? I know a lot of people, swear by that. I just didn't have that experience. I really didn't. So short-term rentals like those listed on Airbnb, VRBO can produce significant higher cash flows than traditional rentals, but they do require hands-on management, marketing savvy, and an understanding of local regulations. A lot of jurisdictions are cracking down on Airbnbs and short-term rentals. So you better make sure that your local authority does allow it. Otherwise, you could be buying something and you can get shut down. In Washington, D.C. area, it's very hard. You have to have licenses, and they only give out these licenses primarily to own occupant. So you got to live there as opposed to doing it as a business. But it varies from jurisdiction to jurisdiction. But be knowledgeable of what your local area allows and what they do not allow, so you can stay compliant. So many investors fall in love with the income potential, but they also overlook the day-to-day grind. It can be a day-to-day grind on this stuff. For example, an investor with a cabin near a national park saw 4 times the income of his short-term rentals compared to long-term lease. But they had to invest heavily in decor, cleaning the rooms, guest communications, and trying to position their product to a niche. So another burnt-out landlord find out that the constant turnover and the guest complaints and the maintenance issue through wear and tear was just too much, and they just got out of it. But successful short-term rental hosts treat their properties like businesses, which you should do anyway. But they invest in what they call guest experiences. So something that's unique, something that's memorable, and that's what they focus on for their units. And they automate bookings and communications, and keep a close eye on occupancy rates and seasonalities, because you could be in an area where you get a lot of seasonal fluctuations, whether it be the winter, the summer, the spring, the fall, and so forth. So when done right, short-term rentals can supercharge your returns. But when done wrong, they can be a drain on your time and also on your finances. Another key element of short-term rental success is location and niche targeting. Properties near hospitals, universities, or tourist attractions often outperform the market. And investors who position their property as a, quote, unique stay, whether it's pet friendly, family oriented, or luxury, often find better traction and guest loyalty. So again, focus on the niches, because that's how you can differentiate yourself from the competition and offer unique experiences. So what are some of the action items associated with short-term rentals? I would suggest that you investigate and do some research on the short-term rental regulations and licensing requirements in your target market. You can use this thing called dynamic pricing tools to optimize nightly stays. What that means is that sometimes if it's high season, your rates could go up. If it's low season, low demand, you may want to reduce your rates in order to attract and appeal to prospective guests. So build a reliable cleaning and maintenance team before launching. Yeah, you're responsible for cleaning the place. And if things go wrong, it's almost like a hotel. People expect you to fix it immediately, and so on. Okay, so that's number 3. So far we've done 3. We've done single family rentals, we've done multi-family properties, and now we've just completed short-term rentals. So we'll as usual, if you got any questions, please put in the chat box. I'll get to them very, very shortly. Anything to do with real estate investing, any problems, challenges, questions that you may have, please put them in the chat box, and I'll get to them in about 10 minutes from now. If you want to book a one-on-one with me where we can do a deep dive into a situation that you're experiencing that you feel is a challenge, but you want my insights and also the opportunity to kind of leverage my experiences, then you can book a one-on-one with me where we can do that. You go to my website, www.joeasimo.com. That's www.joeasimo.com, and we can schedule you in. Okay, so let's keep going. Number 4 is turnkey properties. Turnkey. So the question is, I know a lot of people at one time, a few years back, turnkey was kind of the hot thing. The idea was that you buy a property with everything in place, and you essentially buy a turnkey rental. The big draw was that somebody else did all the work, and now it's a passive stream of income. So the question then becomes, is passive income really passive? Okay, if you buy these turnkey, a lot of people are buying them they just want a reliable income stream, and you and I know that that's not always the case. So anyway, to turnkey, let me define what that is. Turnkey properties are marketed as ready to rent homes with property management in place. So everything is done for you. Okay, you're buying a house, rehab is completed, they found a tenant, and many times they even find they'll manage it for you. So it's really ideal for out-of-state investors, or those people with limited time. While the promise, though, of quote hands-off investing is appealing, the reality is it's not always that way at all. So investors have mixed experience. People who've done this. One investor praised really the provider because they delivered consistent monthly cash flow and detailed reports, while another warned of poor communications and overpriced properties because there's other people in the mix, and they need to get paid. They need to make a profit. So many times you're buying properties at market value with no equity, and so you may get some cash flow, but there's no equity. So if something happens and you need to sell, your options are very limited. So success with turnkeys depend on several things, including due diligence, both on the property and also on the turnkey provider. You must verify everything: inspections, rent rolls, market conditions, and really the credibility of the management company as well. The key is not to abdicate responsibility, i.e. outsource or just wash your hands of this thing, but the key is to delegate it wisely. Okay, delegate wisely. In many cases, investors who succeed with turnkeys almost treat it as a partnership rather than a product. They stay involved in the early stages, set performance expectations, and really establish clear reporting structures. So passive doesn't mean invisible. It means well managed. So it's hard to get totally passive where you don't do anything, but you have to be involved and you have to manage the manager. So what are some of the action items associated with turnkey? Vet the turnkey providers by checking reviews, referrals, and past deals that they've done. Require third-party inspections and independent appraisals. Understand your exit strategy if management fails, and also request sample monthly reports to gauge the property and the property manager. Okay, keep on going. Number 5, house hacking. That's a popular one. House hacking, essentially, you buy a property and you live there, but also you can get income from the other parts of the house. So what if, so the idea is that, the the tenants pay your mortgage. So you can, if done right, live there for free. So that's the beauty of it. I've done house hacking several times. It really is a great strategy, and especially if you're starting off. So house hacking, or living in one part of the property while renting out the other, it has enabled many investors to break into real estate with minimal risk. It reduces personal housing costs and provides living experience, real life experiences managing tenants. You can, as I said before, you can buy a property, and if you're savvy, you can live there rent free, because the income from the other tenants can pay your mortgage. So, but there are tensions. You're living in that, you're sharing properties with other people in close quarters, and so there's possibility of confusion for boundaries, communications issues. Sometimes people's lifestyles aren't compatible, and but it's a powerful strategy for beginners who want to build equity quickly while offsetting expenses. So with the right property and mindset, house hacking can really be a life-changing move towards financial independence. It can be. I swear by that one. Another powerful benefit, though, of house hacking is the ability to get low down payment loans. You can get things like FHA, you can get VA, because you're going to live there, and therefore you can qualify for owner-occupant financing. Or sometimes you can even qualify for grant programs that are offered by the state in your area or local authority. So when leveraged correctly, it creates a real low barrier entry point into multifamily ownership and long-term real estate success. So in terms of action items, look for 2 to 4 units in your area. Plan ahead for privacy, tenant boundaries, and legal leases, and build a small reserve for property maintenance and repairs. And quickly moving on to number 6, which is real estate syndications. And syndications, I'll explain what that means. It's really essentially you're pooling monies together from different people in order to acquire real estate. So can you invest in big deals without being a landlord? Yes, you can through syndications. So syndications allow you, the investor, to pool money into larger real estate projects, and that are often led by more experienced sponsors. And these can be apartment buildings, storage facilities, commercial spaces, whatever. And so for those seeking passive income without day-to-day management, syndications can be a compelling option, but they do require trust and due diligence on your part. Success stories involve things like partnering with sponsors who deliver consistent returns, clear reporting, and strong track records. But on the flip side, things go wrong. You got some sponsors, they have minimal communications, and the results are very underwhelming. So understand the deal structure, the sponsor incentives, and your exit timelines if you are interested or considering syndications. So syndications are best for investors who are comfortable giving up control in exchange for scale. Okay, so you're giving up control because you're not the one managing it, but you're able to get into bigger deals. That's what I mean by scale. They can offer bigger opportunities if you choose the right partner. But if you don't, it can be a disaster as well. So ask questions, understand the business plan, and evaluate alignment between the sponsor's interest and your own, because trust is earned, it's never assumed. And finally, I'm going to talk about number 7 is REITs, real estate investment trusts. And these are, so the question is, what real estate returns do you want real estate returns without owning the property? So it's almost like a security. REITs, as they call them, are publicly traded private funds or private funds that invest in real estate assets. They allow investors to buy shares and earn dividends without direct property ownership. So for those seeking liquidity and diversification, really REITs can play a strategic role. A lot of investors love REITs because of their ease of entry and also passive returns. But the reality is they are subject to market volatility, and they lack the control of physical assets. You don't own the asset by yourself. It's pooled and through securities and so forth. So investors, understand what you're getting into. There can be a great way, but it's important that you know what it is that you're getting yourself involved with. So REITs are best used to complement direct investments, offering flexibility and exposure to sectors like commercial, industrial, real estate, healthcare, and so forth. In addition, though, REITs can serve as a great education tool if you want to get into that. So I'm going to wrap it up now, 7:33. So in closing, let's have a look. In conclusion, invest with clarity, not confusion. Invest with clarity, but not confusion. So real estate offers more paths to wealth than most any other asset type, but only if you choose the right path for your goals. Okay, it's really important you choose what works for you, what makes sense for you. From hands-on single-family rentals to fully passive REITs and syndications, every strategy offers both the opportunity and the risk. There are pros and cons with each. And the key isn't just knowing what's out there, it's knowing what works for you. Successful investors don't stumble blindly into deals. They study, plan, experiment, and adapt. They learn from their failures and borrow wisdom from others. So by understanding the different types of real estate investments and the lessons behind each one, it gives yourself the tools to really build a scalable, sustainable, and hopefully a meaningful real estate portfolio. No two investors are alike. I'm different than you. You're different than me. So, evaluate what makes the most sense for you, your time, your capital, your experiences, and also your long-term goals. Does it make sense for you? So with that said, I'm going to wrap it up and then go to the Q&A. So if you've got some questions, please put them in the chat box. I'm going to get to them in a couple of minutes. So as always, put them in the chat box. I'll get to them. If you want to shoot me an email, I can reach at joe@joeasimo.com, joe@joeasimo.com. And if you want to book a one-on-one with me, go to my website, www.joeasimo.com. That's www.joeasimo.com. And my friends, I think I'm going to get down to Q&As. If you've got some questions, please put them in. And let's have a look what we got today. So today we have Dao2. Hey, Dao2, hope you're doing well in Phoenix, Arizona. And so hopefully this is a good session for you. This is from Wealth and Wellness with Grace. Okay. Hello, Dr. Joe. Great discussion. Thank you. We got Digital Nomad. Thanks for everything you do. I see you as a mentor. Okay. Well, thank you. You're welcome. Again, if you've got some questions, put them in the chat box. And I'll get to them very, very shortly. Dao2, once you give a voucher holder their initial 12-month lease, do you ever give the same tenant a new 12-month lease, or is the tenant on a month-to-month lease forever because of the voucher program? Let's have a look. I think you got to carry on. For non-voucher holders, I have in the past most times given them a new 12-month lease. Okay, so your question, Dao2, is normally when you take on a Section 8 tenant, you enter into what we call a HAP contract. A HAP contract, housing I think it's housing affordability program contract, or anyway, you enter into a contract, a formal contract between you and the housing authority, and the lease that you have is between you and your tenant. Okay, so you sign a HAP contract with your housing authority, but you have a lease with your tenant. Typically, the HAP contract is for 1 year, okay, 12 months. And then after that, it defaults to month to month. And there are specific requirements in a HAP contract that supersedes your lease. So if there's a conflict, the HAP contract overrides whatever terms you may have in your lease. So, and that's a contract that's set in stone. You cannot change that contract, period. It's written by HUD, and it's take it or leave it. Okay, they got specific rules about what you can and can't do. You have to agree that their rules override yours. You got to agree that there's no side deals with your tenants getting extra money. You got to agree that whatever you said, whatever they agree to in terms of the rent is what the rent's going to be. There's a whole bunch of different things that you have to agree to. So for the first 12 months, the HAP contract overrides everything. Now in DC, after that, it then reverts to month to month. So, and it's just, I think it's pretty much the same where most of the places as well. So what I do is I have a rental. My lease is for 1 year or 12 months because the HAP contract is for 12 months. And thereafter that, I don't have to give them a lease every year. We just automatically revert to a month to month. And after 12 months, you can request the rent increases in most jurisdictions. There's a process for requesting rent increases. That depends on where you are. So that's why you need to understand the local execution or implementation of the Section 8 program wherever you are, because it could be different in Phoenix as it is in DC. But generally, it reverts to a month to month thereafter that. So hopefully that answers your question. If you've got some questions again, if you've got more questions or follow-up, please put them in the chat box and I'll get to them shortly. But yeah, so that's the way that works, is that you have a 12-month contract and then you revert to month thereafter that. Okay, so let's have a look. You got a question here. With the current administration, do you recommend not asking for a rent increase even though it's allowed? Oh, that kind of all changes going on with this Section 8 program with the new administration. I think I read yesterday that the current administration is trying to slash the amount that's allocated to the affordable housing or the Section 8 or whatever it is. Yeah, it's real. I don't know how this is going to play out, but one thing I do know, the bottom line is that there are families out there that depend on this program, and probably the most vulnerable of society, which are usually single family headed households with children. So whether the government is going to say, well, we don't care, we're going to throw these people out because we're not going to pay them the landlord's rent, and therefore they're going to be evicted. I don't know if they're going to go to that level. They may. Maybe they could care less if children and single families are thrown on the streets. Who knows these days? But my experience is that they won't do that. My experience is that typically they're going to cut down funding, which means that there's going to be some staff turnover, fired, I suppose, at these housing authorities. What that means is that now you have fewer people doing the same job, so relationships with housing authority staff becomes more and more important because there's fewer of them, and the workload is probably still the same. They usually don't open up they're trying to cut down the number of people with vouchers, so they're not going to expand it, which means that they won't expand the waiting list. If you don't have a voucher, you're not getting one for a number of years. And if you do have a voucher, if you don't play by the rules, you can lose your voucher. So they're trying to save money, and those people who don't play by the rules, they can get terminated. That's both the tenant and possibly you as well. So it's really important to understand the rules, how to be compliant with all the requirements and things like that. So yeah, it's going to be a little rough time until the uncertainty is kind of figured out. But my experience is that the Section 8 program is going to stay. They can't eliminate it. They'll cut it down, and they'll strengthen the requirements. So what does that mean? Do you want to, if you're going to apply for a rent increase, I would suggest that you apply for it right now, because once the cuts come in, they will not allow any rent increases. So if in doubt, I say apply now and make sure that your requested rent increase is quote unquote affordable, given the locale that you're in, number of bedrooms your property has, and things like that. So yeah, it's going to be interesting next few years, but it'll be okay. As the saying goes, this too shall pass. And been doing this for over 35 years, and I've been through a few of these announcements. Let's just put it that way. Okay, it's now 7:43 where I am, so I'm going to wrap it up if I don't get any more questions. So if you've got some questions, please put them in the chat box, and I'll definitely try to answer them. Otherwise, I'm going to wrap it up because I'm tired today. I had a long day. I'm going to be selling one of my properties. This time it's in Maryland, DC, Maryland instead of Washington, DC. So I met with a realtor a few days ago. I selected a realtor, real tough decision, but I selected somebody. And, so I'm looking forward to putting this property on the market probably next week or two. And I've had the property for about 23 years. And after the last tenant left, I just decided, should I rent it again or should I offload and sell it? And I've just decided I'm going to sell this property. And I have enough other properties, so it's not a big deal for me. And then maybe cash out. So, hey, why are you selling? I have never sold a property. Why am I selling? That's a good question. I have a lot of properties. At some point, you need to enjoy the fruits of your labor, as they say. And these properties have got quite a bit of equity. So, I want to enjoy it. I want to travel. I want to do things. And, I've been doing this for a while. So at some point you do need to enjoy it. Otherwise, especially while you got your mind, you still got your sanity in place and you still got your physical health in place. So I don't want to wait until I'm, in a wheelchair and going crazy before I sell those properties. I won't be able to enjoy it. So I want to enjoy it while I have it. And since I have a number of them, it really doesn't matter. I've still got enough other properties which I'm keeping to maintain the cash flow and things like that. So that's, I sat down with my accountant and ran the numbers. And yes, I'm going to pay some taxes on this stuff, but I do want to enjoy the fruits of my labor. I don't think there's anything wrong with that. I think that's what we all should do. It took me a long time. I'm holding these properties for a long time, but I'm picking and choosing the ones which I would like to keep in my portfolio, and the ones which are marginal. If it doesn't make any sense, I'll just sell them, get the cash, and then do something else with the cash. Because it's always good to have some cash around. So anyway, that's the rationale behind that decision, Dao. I don't normally sell, but I'm not encouraging you to sell. I'm just saying what makes the most sense for you. In my case, it's long-term hold. You start off in the beginner phase, and then you go to the growth phase. The growth phase is when you're building your portfolio. You're growing your portfolio, you're buying more properties, you're putting systems in place. And then you get to the point whereby you go kind of like in the harvesting phase where your focus is more on preserve and protect. You preserve what you got, you protect what you got, and then exit based on whatever strategy makes the most sense for you. So that's essentially the different phases. And but I'm not selling a portfolio, no way, because that's what I used to live off. And but I will sell something every now and then if it makes sense. Dr. Joe, do you recommend having an LLC or promissory notes for investors investing in properties together? Okay, so wealth and wellness with Grace. So her scenario is, do I recommend an LLC, which is a formal entity with a partner? So I think she's looking to buy a property or properties, and she wants to know what's the best arrangement. Is it best to create an LLC, with your business partners, I assume, and then you figure out how to divvy up the ownership interest, whether it's 50-50, 60-40, whatever it is. And the operating agreement of the LLC defines, essentially the rules for the LLC, and so on. Now, a promissory note is when you're borrowing money, I think. So if I'm getting a loan, if I want to acquire a property for 100,000, let's just say, and I don't have the money, I can find a private money lender who will borrow me the 100,000, and I offer them a note, or some collateral, which essentially says, okay, then I'm going to pay you X% return on your money, and I have a note, a promise to pay, which pull that together. If I don't pay, then you can take that, take that to court, or you can file that against the property. If and when, so you can sort of collect, or protect your interests. So that's a promissory note. Normally use that with private investors. An LLC, so that's debt financing. You're giving a return on that money, a fixed amount, a fixed rate, or whatever the terms are. The other way is an LLC. So you're giving them equity. So they're an equity partner. They have an interest in the outcome of the LLC. So they get a piece of the action, in other words. So they're not just, a certain percentage of the money that they borrowed. They are getting a piece of the returns, the piece of the, the benefits. So it depends on which one makes the most sense for you. I prefer to give people a return on their debt, as opposed to a piece of the action in terms of the LLC, in terms of the equity. It's just easier for me anyway. I'm not a great fan of partners, unless you really, really know them well, unless they're bringing something unique to the table. It can create some opportunities, but it can also be difficult because, you really don't know anybody until you've, almost like a marriage. So, I'm careful who I marry. How about that? And do your due diligence to make sure you're marrying the right person. Because once you marry them, it's hard to separate. It can be very expensive to separate as well. So be careful if you have partners. Vet your partners very, very carefully and make sure that they're in sync with what you're trying to do. Good question. Hope I answered your question, Grace. If I haven't, please follow up again and I'll continue. She says, thanks so much. My real estate attorney also recommends a promissory notes initially. That's what I do. Just give them a percentage of a return on their money, as opposed to, control of your entity. Because once they have ownership interest, it can be difficult to separate if you have to, and people do change. So, good question. It's now 7:51. I'm going to wrap it up for the day, unless I'm going to get some questions in the next 15 seconds. Again, if you want to book a one-on-one with me, you can go to my website and www.joeasamoah.com. That's www.joeasamoah.com. You can book a one-on-one with me. We can do a deep dive into any situation, any problems, any challenges that you're experiencing. If you want to shoot me an email, you can email me at joe@joeasamoah.com, joe@joeasamoah.com. And with that said, my friends, I'm going to wrap it up, and I will see you next Wednesday at 7 p.m. Eastern Time. Have a wonderful week. Take care. Bye for now.